Hello everyone, welcome to chapter 3. This is going to be a really important chapter because here I'm going to talk about something that ties everything together. The topic of this chapter is going to be putting everything together. Basically, everything that I've discussed so far in CPI or TC, I'm going to bring it all together into one complete system and I'll give you the exact structured approach you need to analyze the charts properly, execute trades with precision, and to stay consistent, right? I'll also walk you through some key intricacies around risk management because understanding risk is just as important as understanding the charts. So let's get into it. So let's start with the foundation. What is a trading plan? Now, I know it sounds like the usual thing that every trader hears you need a trading plan to be consistent, obviously, and I know it's a bit cliche, but the reality is that most traders don't actually understand what a trading plan is made of or how it functions in practice. They might have a general idea, but not the actual framework. And that's why in this chapter, I'm going to make sure to break it down for you completely so you understand exactly what it is and what is it made of. Now, a trading plan in its simplest form is a structured approach to executing trades, and one that's based on a set of predefined rules, risk parameters, and liquidity dynamics. And what that means is that you need to understand how liquidity behaves, and then based on that, you need to build a higher time frame narrative around it, and finally, use a clear rule based method to take trades that align with that particular narrative, right? That's what makes it a proper plan. Another way to look at it is that a trading plan is your operating system, right? Basically, it's the full framework that covers everything: how you execute trades, how you manage risk, how you think about the markets, and how you stay aligned with institutional structure and liquidity behavior, and so on, right? It removes randomness and gives you a focused and a repeatable way to show up to the market every day. Now, when we talk about what makes up a trading plan, it's important to understand that there are two kinds of components. There are active components and then there are passive components. And both are equally important, but they serve different roles. Active components are the things that you use and apply directly on the charts. You use them daily on a daily basis, and they're part of your live chart work and part of your real time decision making process. For example, the first active component is your high time frame directional bias and liquidity framework. And with this component, you determine your drawn liquidity and the overall direction of the market. And similarly, the next component is your narrative and market context. And this helps you understand how price is unfolding and how you interpret that structure into a trade idea. And then after that, you have your entry trigger. This is basically the actual signal that tells you that a trade idea might be setting up. It could be in the form of a purge or a tap into a key level or a key time reaction, right? Anything that meets your setup criteria is that entry trigger. And then there's your actual entry criteria, which is the exact technical way you enter. Maybe it's a FVG entry or an order block confirmation or maybe a turtle soup setup, right? Whatever fits your system. So these are all the active components. And similarly, along with that, you've got execution. And this is where you actually take the trade. You place your entry, you determine your stop loss and take profit levels, and you do it all based on a structured plan that you've built. These are the components that you engage with actively every single day on the charts, and they're actively used in your decision making process. Now, let's get into the passive components of a trading plan. These are just as essential and important as the active ones, but the catch is that they don't show up directly on the charts. They work in the background, they work behind the scenes, and basically they shape the quality of your decisions and keep your system organized and make sure that you maintain the consistency and the type of consistency that trading truly requires. Now, within passive components, the first passive component is time frame alignment. This basically determines the structure of your entire analysis. It tells you what time frame you will be using to analyze the market and what will your execution time frame be. For example, if you want to day trade or if you want to become an intraday trader, then your high time frame would be the 4 hour and your executing time frame would be the 15-minute, right? That would be your framework. Similarly, if you're using the daily as your higher time frame, then for execution or for entries, your lower time frame would be the 1 hour. That become your lens. It defines whether you are scalping, day trading, or swing trading. It also ensures that your entries are always in sync with your higher time frame context, which you know is crucial for both accuracy and consistency. The next passive component we have is risk management, which is probably one of the most overlooked areas in trading, but it's also one of the most important one. And no, this isn't just about risk 1% per trade. It's much deeper than that. Yes, your risk model includes your risk per trade, but it also covers how you handle drawdown, whether you use dynamic or fixed position sizing, how you scale in and out of trades. It includes your maximum exposure across correlated pairs. It includes your weekly risk limits and even the psychological tolerance you have for losing streaks. It defines your safety net, right? So you can survive long enough to be able to thrive. That's the importance of risk management. And then we have performance tracking and review. And this is where you journal your trades, track your setups, and review your results. But it's not just about wins and losses. It's about reviewing your execution, your analysis accuracy, and your emotional decision making. Right? You want to ask yourself, did I follow my rules? Did I enter with confirmation? Was my narrative aligned with the drawn liquidity? And then you have to journal all of your thoughts and all of your thought processes and make sure that they are aligned with each other and they're consistent. Right? And by doing this regularly, you'll start to notice patterns in your own behavior. You'll identify whether you are consistent and whether you are inconsistent in your sleeping. And this process can alone bring massive clarity into your system, sometimes even more than the actual chart work. And finally, there are other passive components that still matters like pre-session analysis, psychological self-evaluations, and environmental consistency. These aspects don't directly impact the charts, but they have a huge influence on how well you show up as a trader and how well you perform as a trader. And as a trader, your ability to stay calm, detached, and focused often comes from how well you manage these behind the scenes or these background components. And if you are managing them properly, then you'll be more disciplined and more consistent. So, while active components are what you actually use to take a trade, passive components are what keeps you consistent, focused, and in control of your process over the long run. And without them, you might have a good strategy, but you won't have a sustainable system. Moving on, in this slide, I'm going to explain my exact structured approach to analysis, how I go from the higher time frames down to the lower time frames in a top-down approach, and how I navigate between each time frame, and how I use that structure to create precision and accuracy in my analysis and execution as a whole. Now, as a day trader or an intraday trader, my entry time frame is typically the 15-minute, and I use the 4-hour time frame to map out candle ranges, key levels, or to basically build a market context. Now, this time frame alignment works best for the way how I approach the market. Now, of course, depending upon what kind of trader you are, your time frame alignment or your combination of time frames might be different. For example, if you're more of a swing trader, then you might use the daily as your higher time frame and then the 1 hour for your execution, right? You can see the different time frame alignments down below. Now, let me walk you through my exact analysis process and how it is broken down, how it is actually broken down. Now, I don't just open a chart and guess immediately. My process is divided into 4 clear steps: long-term top-down analysis, intermediate-term top-down analysis, short-term top-down analysis, and then finally, intraday top-down analysis and execution. Each step has a purpose and each one builds on the one before. First of all, I start with the long-term top-down analysis, and that analysis is purely done on the monthly time frame. The entire purpose of this step is to identify the macro drawn liquidity and the long-term directional bias. Basically, I want to understand what price is ultimately being drawn toward over a longer period. And in order to do that, I integrate macro concepts like quarterly shifts, seasonal tendencies, dealing ranges, and the overall and relevant monthly key levels. And basically, these help give me the broader perspective of what the market actually wants to do or what the market wants to achieve over time, right? Even if I'm not trading those moves directly. And once I have the long-term view, I then drop down to the weekly time frame for what I call my intermediate top-down analysis or intermediate term top-down analysis. And basically, this step helps me refine that long-term drawn liquidity and also identify any short-term drawn liquidity or liquidity targets that price potentially may reach for before it starts moving toward that long-term draw. And to get this right, I use a structured approach that combines the following concepts: weekly dealing ranges and key levels, power of three, and weekly open high low close levels. And these tools help me determine the weekly order flow, and it helps me set a more specific bias for the current week and for the current days ahead. And once I do that, then I move into the short term top down analysis step, which is where I focus on the daily and the 4 hour time frames. And basically, this part is all about figuring out exactly what price is most likely to do for today, not tomorrow, not the day after tomorrow, but what price is most likely going to do the current day or the current daily candle that we have. And what I want to do is that I want to refine my directional bias, dissect the ERL and IRL dynamics, and figure out what kind of move we are expecting. Is it a retracement, a continuation, or a reversal? And exactly how far can that move go? And here again, I'm still using dealing ranges, key levels, and open high low close levels, but also I'm layering in weekly profiles too to understand how today's movement fits into the broader picture that we have on the higher time frame. And this is where I built the market narrative, the story of what price is trying to do and why. And that particular narrative becomes the foundation for my trade ideas on the lower time frame. And finally, once all of that is done, once I've identified the drawn liquidity, set the directional bias for the day, and built the narrative for my trade ideas, and built a proper market context, I then move into the intraday top-down analysis, which is where the actual execution happens. This is done on my lower time frame, usually the 15 minute, and it's where I start looking for real trade setups in my entry models. And at this point, I'm using intraday profiles, including the behavior of the Asian session, London Open, and New York session. And I'm paying close attention to the open high low close levels of the current daily candle and how the market is reacting to the previous key levels and candle closes. Right? I'm studying the orientation of the Asian range to determine whether price might go for a normal protraction profile or an intraday protraction profile. Right? But most importantly, along with all of those things, I'm waiting for my entry model to form around the market context that I built on the 4 hour time frame, right? That could be the upper edge of a candle range, a rejection from a key level, a divergence, or maybe a combination of all of these things. But I only execute once it's fully aligned with the higher time frame market context and narrative. And I only execute when everything aligns, when my entry model is confirmed and the narrative makes sense and the risk is manageable, right? When all of these things align, only then I execute. And along with that, I clearly define my entry, my stop loss, and take profit levels. And from that point, the trade is either valid or it's not, right? There's no guesswork. So that's my entire structured approach to market analysis and execution. I start with a macro view and gradually refine it layer by layer, time frame by time frame, and then I end that with a focused and an actionable setup on the intraday level. And this process removes any noise, keeps me consistent, and gives me complete clarity on what I'm doing and why I'm doing it. Right here, you can see all the steps in my structured approach to analysis. First of all, I determine the high time to draw liquidity, and that involves identifying whether price is reaching for long-term external range liquidity or long-term internal range liquidity. And then I determine if there are any short-term ERL or IRL levels that may act as intermediate liquidity targets. And once I've done that, I then refine the drawn liquidity on the daily and the 4 hour time frame, and I then pinpoint the exact daily drawn liquidity to understand where price is likely to target today and what's the most probable and what's the most likely move for today. Basically meaning that I establish the daily directional buys or daily buys. And after that, on the 4 hour time frame, I build a narrative on how price could reach that drawn liquidity. And I do that using open high low close, the power of three weekly profiles, and I use all of them together and integrate them together to figure out exactly how price could move towards that drawn liquidity. And then after that, I build a market context around that narrative on the 4 hour time frame, which means that I identify the correct candle ranges and key levels within our current dealing ranges. And once that is done, I then drop down to the lower time frame and wait for my entry trigger in my entry criteria. And that could be in the form of waiting for a key level and waiting for a purge at a key level, waiting for an order block confirmation entry to be formed. And once I've waited patiently for those entry triggers and entry criteria to form, only then I execute my entry model, and I make sure to do that with proper risk management. That's my entire structured approach, right? It can be summed up in these 6 steps, starting with the high time frame drawn liquidity and then ending it with my actual execution of my entry model with proper risk management. Okay, so now that we've discussed everything about trading plans and their importance and their components and everything about my structured approach to analysis and execution, now let's move on to another important topic, which is risk management. I've told you this before, and let me tell you this again. Please understand risk management, because I know and every single profitable trader knows that it's one of the most important prerequisite and requirement for you to become profitable, right? Without it, and or without being aware of its intricacies and details, you can never become profitable. And in this next part of this chapter, I'm going to make sure that I explain every single detail of risk management, and by the end of it, you'll know exactly what it is, how are you going to approach it, and you'll be completely aware of its details. All right. First of all, let's clear up some common trading myths or misconceptions about risk management, right? These are the things that gets thrown around a lot, but they are either too oversimplified or just flat out wrong, right? In this slide, I'm going to break down these myths, right, that we constantly hear, and I'm going to replace them with the real facts, right? Ones that actually matter in real time trading, in real world trading. So let's start with the myths. The number one myth or the biggest myth is that risk management is just about how much you risk per trade. And that is one of the most misunderstood ideas in trading. People think that as long as they risk 1% per trade, they've got risk management handled. But the reality is that that's just only a small part of it. And real risk management goes way beyond just setting up a percentage, right? It's about your position sizing, your trade selection, your risk to reward ratios, your risk tolerance, your emotional control, and your overall awareness of the market context. That's what's included in risk management, not just setting up a percentage. And yes, risking low per trade and not over leveraging is a part of it, but that's not the complete picture. And you have to realize that. The second myth is that more trades equal more profits. And again, that's completely wrong. More trades often just mean more exposure, more mistakes, and more overtrading. Profits doesn't come from quantity, it comes from selectivity, precision, and accuracy, and following your system with discipline. What really leads to more profits isn't taking more trades, it's being able to consistently follow your rules, and it's your ability and your competency, regarding whether you can consistently stick to your system or not, right? That consistency, that discipline is your edge. And those things equal to more profits. Moving on, the number three myth is that you need a high win rate to be profitable. And again, that's a huge myth that traps a lot of traders. Because the reality is that you can actually have a 30 to 40% win rate and still be consistently profitable. In fact, most of the profitable traders I've experienced or I've seen have win rates lower than 50%, but they still make a lot of money because they know that the real power is within risk management and risk to reward ratio, right? And that's what they've realized, and that's why even with a lower win rate, they're still profitable. And the reality is that if your risk to reward ratio is strong and you manage your losses properly and you know how to handle drawdowns, then you don't need a high win rate. Yes, you can achieve that. You can work towards that, but that shouldn't be your main priority or your main objective when trading. Because profitability in trading is not about how often you are right. It's about how well you manage your wins versus your losses and how well you handle your drawdowns. Because you can win 3 out of 10 trades and still come out ahead if your risk to reward ratio is 1 to 3. Right? Even with a 30% weighted, you can still be profitable if you just have a 1 to 3 risk to reward ratio. That's why the focus should be on quality and not frequency. The number 4 myth is that moving your stop loss to break even as soon as possible is a good idea. Now, obviously, it sounds good in theory, right? Locking in safely early. But in reality, doing this too often, too soon will often get you stopped out before the trade has time to play out. Right? The reality here is that you are protecting pennies and you are losing dollars. Break-even stops do protect capital, yes, but moving them too soon can ruin the entire setup. And price often needs to breathe, right? Price doesn't just go expand immediately from your entry level. It often need time to maybe consolidate or range before it could expand toward your target. And the better alternative is to lock in profit and trail your stop loss to break even based on order flow, based on structure, and based on timing, and not based on fear or emotions. The number 5 myth is that tight stop losses reduce your risk. And again, this one is a dangerous myth. A tight stop loss does not reduce your risk. Instead, it increases your chances of getting wigged out or getting manipulated out of the trade by normal price fluctuations. Right? And the worst thing is that it can lead you to missing perfectly good setups just because you didn't give those setups room to breathe. The reality is that tight stop losses do not reduce risk. The only thing they reduce is your chance of being profitable because you keep cutting yourself out of good trades before they even get started. And you need to realize that a good stop loss is logical, right? It's not emotional. A good stop loss is logical, not emotional. It's based on structure and not ego. These were some of the myths and the counter facts that you need to accept and you need to remember when going through your trading or going through your trading journey. Moving on. Now, let's talk about something that's often overlooked but absolutely vital for long-term profitability in trading, and that is balance, specifically the balance between win rate and risk reward ratios. This concept right here is where a lot of traders lose their edge because they get too caught up on one side or the other. A healthy balance between your win rate and your risk reward ratio is key. You can't go all in on one and completely neglect the other. If you only chase high win rate but accept tiny risk to ratios, or if you go for massive RRRs but go for lower win rates, then these both extremes can lead to serious problems in the long run. Now, if you're too focused on either side, whether it's keeping your win rate extremely high while settling for small risk to ratios, or going the other way around and accepting really low win rates in hopes of hitting some crazy 1 to 10 risk to ratio trades, then both of these extremes eventually creates psychological stress, inconsistency in your trading, and poor performances. You'll either be hesitating all the time or forcing trades that don't make sense, right? Neither of them is sustainable. But when you strike that healthy middle ground, everything changes. You gain emotional stability and you're no longer attached to being right every single time. You stop second guessing, and most importantly, you gain the confidence to execute trades without letting emotions take over. And this balance right here helps reduce emotional decision making and revenge trading. It makes your trading system feel smoother and more sustainable, even though you still face losses or periods of drawdowns. Now you might be wondering, why is that such a big deal? Well, let me break it down for you. First of all, fear of losing and perfectionism. When traders obsess over maintaining a high win rate, they start to fear taking losses, and that fear leads to hesitation. They hesitate to enter trades, and they hesitate to follow their setup even when their setup is clean and valid. Why? Because they are too scared that that one loss will ruin their win streak or hurt their ego. So what happens is that they start avoiding good trades, they overanalyze and they complicate the process. They overcomplicate the process. And that's what we call analysis paralysis. And it all stems from the concept of perfectionism. You're trying so hard and too hard to be right every time that you forget that your real job is to execute your edge and not to be right all the time. The second thing is that it spikes and it enforces emotional instability during losses. Now we know that every trader faces losses, losing streaks, or drawdowns, right? That's completely normal and that's inevitable. But traders who are hooked on higher win rates, and those traders who chase that 80 to 90% accuracy, they really struggle when those losses come. And when they do come, a few back to back losses suddenly blows their whole picture into panic mode. They start doubting everything. They start doubting their strategy, their system, their entire entry models, and they start to revenge trade. They overreact. When in reality, those losses are completely normal and they're nothing to be scared of. And that emotional spiral destroys their whole performance faster than any bad setup ever could. Now, compare that to a trader with a balanced risk to reward ratio and balanced win rate system. They expect losses, they factor them into the equation, and when a loss happens, they just consider it a part of the process. They don't take it personally. They stay calm, they stay consistent, and they keep executing their system. And that's what gives them the edge over time, right? So, whether you are building a system or trying to refine your mindset, remember this: it's not about being perfect, it's about being balanced. A high win rate does not mean anything without solid risk management, and a higher risk to reward ratio does not mean anything if you are not mentally stable enough to survive the losses between wins, right? So, find your balance and you'll find your edge. Remember this. Now let's move on to the last slide of this chapter. And here let's talk about something that's just as important, if not more important, than your technical analysis. And that thing is risk awareness. The idea here is that most traders come into this game thinking that it's all about entry models, it's all about order blocks, FVGs, and technical setups. And while those things matter, they're only one side of the equation. The other side, the one that separates consistent profitable traders from emotional traders, is risk awareness. Now, the first and most fundamental aspect of risk awareness is simply learning to accept losses as a normal part of trading. The reality is that you are going to lose. You're going to lose trades. They are inevitable. And it's not an if, it's a when. And losses aren't a sign that your strategy is broken or that you are a bad trader. They're just a part of the cost of doing business, right? They're just the opportunity cost of doing business. And the quicker you normalize this, the more emotionally stable and resilient you become, right? That's the most fundamental aspect of risk awareness. The next thing is that managing and handling drawdowns effectively. Now we know that drawdowns are unavoidable, they will happen. Whether it's a bad week, a few missed setups, or just market conditions not aligning with your system. The difference between a professional and an amateur isn't who avoids drawdown, it's who survives them. You need to ask yourself, can you keep your head straight when you are going through a rough patch or a losing streak? Can you stay disciplined when your confidence is low? Right? You need to ask that. And risk awareness means having the plan, the mindset, and the coping mechanism to endure those phases without without being emotionally broken or without letting emotions get the best of you. That's the importance of risk awareness. Third of all, you need to understand the power of your risk to reward ratio and how it relates to your win rate. Now, I've already explained this in the last slide, right? I already told you about the details of these two together. So I don't need to elaborate on it further. Moving on, the fourth element is emotional discipline and psychological stability. Right? This isn't just about being calm while trading. It's about knowing how your emotions show up in the market. And are you someone who gets aggressive after a loss? Do you hesitate after a losing streak? Are you afraid to size up when things are going well? Right? All of those things fall under emotional risk. And risk awareness means knowing your emotional triggers and having systems and coping mechanism in place to manage them before they cause real damage. This is also included, or this is also an aspect or an important part of risk awareness. And finally, you need to be tracking your performance and analyzing your risk metrics. If you are not reviewing your trades, you're not tracking your risk metrics or analyzing your risk exposures over time, then you are flying blindly. You can't improve what you don't measure, right? That's the reality. You can only improve something if you measure it. And journaling your trades, logging your setups and your thought process and checking how closely you're following your risk model, all of that matters. This step right here gives you real data that you can use to refine and improve not just technically, but emotionally and strategically. And all of these pieces, whether it's loss acceptance, drawdown management, emotional control, and performance tracking, are all part of what makes a true risk awareness. Because at the end of the day, it doesn't matter how good your entry is. If you don't know how to manage your risk, it doesn't matter how accurate your bias is, how accurate your analysis is. If you panic the second the trade moves against you, then risk awareness is what holds you and your entire trading framework together in those sort of scenarios. Right? And just like it says right here, risk awareness, it is just as important, if not more, than the technical side of your trading. That was it for this chapter.